Nation, back with another video. Today I wanted to talk about option calls and option puts. We're not going to dive super deep into all of the Greeks and etc. This is going to be a very basic video. Once you watch this video, this doesn't mean go ahead and start trading options. Okay? There's a lot to know about options. You have a lot of factors that are against you and a lot of factors that could help you. But we're just going to be talking about the basics of an option call and an option put. So, first you would load up your trading app, right? Whatever broker you use. We're just going to be on Robinhood because most people are using Robinhood. But if you have Webull or E-Trade or any of these other platforms that offer options, it's going to be the same thing, okay? It just looks a little different. So right now, the options we are going to be looking at is Tesla. So at the top you can see here, this would be your ticker, so the company that you are purchasing options on. So one thing to note, they have the dollar figure of what the stock is trading at and the percentage it's gained today. Okay, so we're going to be talking about option calls first. So an option call, right, you would be doing buy call because you want to buy a call, right? Okay, so buying a call means you think the stock is going to keep going up. So, for example, as you can see here, these are the prices that the sellers are asking, right? Because you have two people on this transaction. You have the buyers, which we're trying to buy, and then you have the sellers right here, and they're trying to sell out of their positions. It's a two-way transaction. Same thing if you were to go to a grocery store and go buy something, right? Somebody's selling you that product. This is the same thing. Okay, so don't try and overthink this. Right? So, and then you have your seller side, which is if you have a contract and you want to sell it, you would put an ask price for it. Or sorry, a bid price for it. You'd put an ask price for it. Sorry, not bid price. So, as you can see here, these are something called the strike prices. So, the more you go down, right, into options, the more expensive the strike price, the more expensive the ask price is going to be. Well, why? Because you're taking a much less riskier position. So if you were to buy a $100 call on Tesla, right? Tesla's already trading over $350. You know, if the stock moves a couple dollars, you're going to make a ton of money, okay? And also, it's a lot of people do buy these options down here, right? Not necessarily down there, but big people do, right? But if you could have a way of, you know, holding a 290 call, or, right, let's say just the other day Tesla dipped down to 330, right? And you bought a 330 call yesterday. I think this was valued at around $800, $900, because it was trading around 320. Today you'd be up $2,000. We're going to get into the math a little bit on this side here. And then on your right side, you have your break-even price. So, you know, there's not something, so when you're trading options, there's something called the Greeks. Like I said, we're not going to dive into this, but this break-even price does not include the Greeks. I just want you to know that. To break even, this 1%, so if it pops up 1%, so if Tesla goes to 4.6%, you'd be at break even. Keep in mind, this is not considered with the Greeks. And then you have your percentage change, right? So this percentage change, it's changed 180% as of today in price. So if you bought it yesterday, right, you're probably up 180% in the price. And then this would just be the figure amount right here. But I want you to keep something in mind, right? You aren't buying, this is not $5 worth of options, right? This is $530 worth of options. Why? Because you have to buy 100 of them. Okay, you have to buy 100 of them. That's the thing with options. You have to buy 100 of them. So it does require, don't get me wrong, Tesla's a very expensive stock, but trading options does require some capital. I say minimum probably $1,000. You know, a lot of people try to do $50 option, like $50 accounts and $100 accounts. There's just no way, okay? Yeah, very few people can do it, but you have to be very, very good. You have to know options for years, but the chances of you starting out and using $50 and $100, it's just not going to work out. So anyway, let's say we're going to buy this contract right here for for the strike price being 350 and the price is 540. So you would just take the 540, right, and times it by 100. So you get 540. So that's how much it would cost for you to own this particular option call. Very simple. It's not too complicated. So if it's 0.66, right? So 66, you times it by 100, right? $66, okay? $7 right here. This contract's worth $7, right? We scroll down. This contract's worth $1,500. We scroll down. This contract's worth $10,000. It's not too hard. You just multiply it by 100, and so at the bottom here, this contract would be $25,000. So it's not too hard to do the math on it. You just times by 100. Very simple. And then we're going to, and then the last section I want to talk about before we head into puts, your expiration. Okay. So when it comes to options, right, you have a couple different way of trading options. You could be a day trader with options. You could be a swing trader with options. Or you could be something called a leap trader with options. Now, I would, if you're a day trader with options, sometimes your expiration would be on the same day, or you can use the 8-day expiration, and you could still sell that same day. I know a lot of people who prefer to go to the 8-day versus the 1-day just because of the Greeks. Like I said, we'll talk about that in a different video. And then anything out more than a year, or anything out more than 8 days, even if you're holding it for like 3, 4, 5 days, you're considered a swing trader at that point. And then when you get into the leaps, so the leaps would be anything over a year, right? So for example, let's just take this for example right here. As you can see, right, the farther you go out for expiration, the more expensive these contracts are, okay? These contracts are very expensive. So just like we saw, this contract right here is $8,000, and the strike price is $350. But if we go to the 15-day expiration, $350, it's only $1,500. So you could see the longer expiration you have, the more expensive your contract's going to be. So that's why some people tend to do like the 8-day expirations, because they aren't that bad, right? And you still have a couple days to get rid of the contract if you need to. If you need to sell for a loss, you can sell. But this is basically, and we're going to get into the Greeks obviously later on in a different video, but I just want you to keep in mind, the shorter your expiration is, the less expensive your contract would be. And there's a reason for it. Next, we're going to be talking about the option puts. So, option puts, same thing, right? You have your strike price break even percentage change. So as you can see, since Tesla pushed 3%, almost 4% up in the market, these contracts are getting smoked right now. 45%, 50%. These contracts are getting absolutely killed. Even the top contracts, right? They're down very big percentages. Look, 2% on a $60,000 option. That's a lot of money. That's being taken away from these options. And then obviously your expiration, it's the same thing. The longer out, the more expensive it is.